Good afternoon, everyone, and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Baillie Gifford. I'm Katrina Lloyd, I'm Editor-in-Chief on Professional Advisor, and I'm going to be your host for the next hour. But before we get going with today's session, let me quickly run through the usual housekeeping. I should inform you this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session. Scottish Mortgage is determined to own the world's most exceptional growth companies and deliver long-term returns to their shareholders. Over the next hour, I'm going to be joined by Claire Shaw. She's Investment Specialist Director with specific responsibility for the Scottish Mortgage Investment Trust. Claire will explain why having an unconstrained global mandate helps them on this mission. We'll discuss why Baillie Gifford sees significant amounts of progress being made in every corner of the globe in both public and private markets. From the digitisation of finance in Latin America and space travel in the US to luxury goods in Europe and technological transformation in Southeast Asia, they think the growth potential is abundant. Do feel free to put your questions to Claire using the chat function. You'll find that at the bottom of the screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box. And before you type your message, so only I can see it. And I'm just sharing the housekeeping there for you about the CPD as well. So just before I hand over to Claire, let me quickly run you through our learning objectives today. You should be able to see those on the screen now as well. So by the end of the session, delegates will understand the unique philosophy that sits at the heart of Scottish Mortgage, understand why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it is rational to seek out the exceptional companies driving this change to maximise your chances for growth over decades, and understand why the current environment leaves room for optimism for investors willing to take a long-term, patient view. So now let's hear from Baillie Gifford's Claire Shaw. Afternoon, Claire. Lots to talk about today.
Good afternoon, Kat. Thank you very much for having me. Perfect. I think we're just loading up the presentation here. So good afternoon, everybody. I appreciate everyone taking the time during their lunch break to come and listen to this presentation on Scottish Mortgage. I plan to talk for about 20 minutes or so and leave plenty of time for questions. But I thought it would be helpful just to start with a recap as to what our proposition is. And I really think the purpose of Scottish Mortgage is incredibly simple yet compelling. And at the core, it's really this combination of public and private companies in a liquid and low-cost vehicle traded daily on the FTSE 100. And as Kat alluded to in her introduction, what we are trying to do is one thing, which is owning the world's most exceptional growth companies, whether public or private, owning them for the long term so that we make excellent returns to you, our shareholders. I actually think that in this day and age, portfolios are increasingly incomplete without private companies. This is now a 5 trillion asset class. Companies are staying private for longer. You've got some of the most unique and largest companies in the world now still private. SpaceX, which I'm sure we'll come on to, ByteDance, the parent company of TikTok. Both these companies would probably be the biggest companies in the FTSE 100 where they're listed in the UK today. But our purpose at Scottish Mortgage is we want to sort of democratise access to what is a particularly expensive asset class historically by offering access to privates in a low-cost manner. So the format of the presentation today is just sort of taking you through the kind of 5 attributes that I think give Scottish Mortgage quite a distinctive DNA. But through this presentation, just really give you an update on the portfolio, what we've been doing in terms of activity, new buys and sells, where we've been taking some profits, and where we've been recycling that capital. So just to recap, what do I think are those sort of 5 characteristics? Well, firstly, it's seeking outliers. We're looking for a very particular type of company and a very particular type of return profile. Secondly, it's our belief in disruptive innovation. So I'll talk about some of the structural growth trends that we see. Thirdly, it's the benefits of that private company exposure and give you an update of our private holdings as it stands at the moment. Fourthly, it's the benefits of being globally unconstrained. I think there's been a lot of chat about the US and US equity valuations. I'll go through what we've been doing in the portfolio and taking advantage of some valuation anomalies in other parts of the world. And then finally concluding with our long-term history, just talking about performance more recently. So just moving to the first of those, the seeking of outliers. I think for those that maybe heard a Scottish Mortgage presentation in the past, you'll have heard us say that the structure of stock market returns over decades reveal this really clear pattern, which is that only a small number of companies derive the majority of stock market returns. And the pattern's incredibly clear for Scottish Mortgage as well. It's only a small number of companies that have driven those returns for us as well. And our philosophy is grounded in exploiting this asymmetry, if you like. And the reason's very simple why we set up this way, which is that if we are right about a company, the maximum we can make is unlimited. The upside is essentially uncapped. If we're wrong about a company, the maximum we can lose is what we initially invested. So that downside, if you like, is bounded. I often say that we're optimists, not pessimists. So we often think about what can go right, not what can go wrong. But the key to sort of capturing these sorts of returns is really being long-term and patient. And that's not easy, as humans aren't naturally patient. You know, you quite often find that the majority of the market will sell at the first sign of turbulence, and they're going to miss out on those big gains. And I think that you have to be comfortable with the fact that extreme returns and smooth performance are mutually exclusive. You aren't going to get both. And so at Scottish Mortgage, we're extremely comfortable with the fact that those biggest outliers are often the most volatile. And you can see that on the slide on your screen. If you look at our big winners, you know, your Nvidias, your Teslas, your Amazons, etc., there has been some big drawdowns in those stocks. So let's take Nvidia, the stock on everybody's minds right now. You can see on the left-hand side of the chart, we've made nearly 100 times our initial investment on that stock. But during our holding period, I think there's been something like 16 or 17 periods where the stock has fallen more than 10%. The worst of those was about 60%. And I think this is really important because when you come back to our philosophy about, we think our job is to support companies during the kind of good times and the bad, you know, we invest for the long term because it takes time for those characteristics of these exceptional companies to be fully reflected in share prices. So I thought it'd be useful just to talk about this in the context of two quite high-profile stocks that is creating quite a lot of talking points at the moment in Nvidia and Tesla. I think it's important to talk about the fact that it's not just about us being patient in these companies and seeing that share prices being reflected, but it's also about being able to identify these companies early because of the benefits that kind of reaps for shareholders. So what this chart's really showing you is that with Nvidia, we first bought this company back in July of 2016. And it's quite staggering. Back then, we deployed about 65 million of shareholder capital into the stock. And to date, we've taken about 1.3 billion of profits out of that position. It's still about a 2% position in the portfolio today, and nearly about £500 million worth in terms of the market value of that. So there's still that huge unrealized gains in the portfolio. But as I say, I think when you actually take a step back where we were, if you go back to about June of last year, I would say, Nvidia was probably about our largest position in the portfolio. I think actually at the end of the half year, it was our largest position, sitting at about a 9% holding. What we've done really during the year is probably taking quite a lot of profit out of that. And this is really to do with our ongoing thinking around the evolution of AI. I think it's safe to say Nvidia's dominance in pre-training is clear. But the market is facing challenges as you're seeing that data constraints and limiting growth potential. So from our perspective, we think that even though Nvidia's position is still robust, you know, any kind of changes in that kind of near-term monopoly, if you like, could significantly impact its pricing and its stock price. So just from a Scottish Mortgage perspective, I think it's important to note that we have taken quite a significant amount of profits out of that position. But I guess coming back to that concept of being early, you know, we bought this back in 2016, and I thought it'd be quite an interesting exercise going back and looking at what were we saying about AI in 2016? What were we thinking about Nvidia and its position in the AI value chain back then? When I look at our initial notes on that, you know, we had an interesting phrase in there, which we said that I think that deep learning and AI applications could have a similarly transformative effect on our lives as the PC and mobile phone. So I don't think it's completely outrageous to think that they could lead to comparable growth. So even if Nvidia takes a fraction of that resulting market, this could eclipse the value created by their existing business. Now, I thought it was interesting just in the lens of how we're thinking about the world, and I'll come on to this in terms of structural growth themes. But our positioning in NVIDIA and the returns that we've been able to make for our shareholders are because we're thinking about these themes, years hopefully ahead of other people. I think Tesla's a very similar story. We first bought for the trust back in 2013. You can see in that chart, we deployed about 320 million of shareholder capital into this position. And to date, we've taken 4.5 billion of profits out of that. And just to put that into some context, about 20% of that has been in the last quarter of 2024 and the first part of this year. So just to give you a sense where that leaves our position, Tesla is now less than 1% of Scottish Mortgage today. And that represents the lowest position we've had in about a decade. So that just gives you a sense, and we can come on to that later about our rationale on the Tesla position. But I think by showing these numbers here, I don't think we're trying to say how clever we are. I think it's just showing that really for us, our edge is our time horizon. And that really, when you're trying to convert kind of new ideas and new technologies into these growing businesses, it does take time. But if they're successful, the rewards are profound. So I think it's safe to say there's a lot of noise in the market right now. Trump, tariffs, Russia, Ukraine, China, the list goes on. And from our perspective, we think there's a really kind of short-term contrast, if you like, between that kind of short-term market preoccupations and the kind of valuable long-term growth trends, which we spend our time focusing on. And in our opinion, that kind of company innovation really matters more than the economic cycle. The market's far too short-term and focused, too distracted by noise, and loses focus of the long-term effects of that kind of those disruptive technologies. And you can see on that kind of donut-shaped diagram on screen there, just how we're exposed to some of these kind of interesting themes, or where we see structural growth themes. And I think there's a very particular type of company we're looking for in Scottish Mortgage. We're typically looking for those companies that are either disrupting industries or creating new ones. And I said in my intro that we're looking for the world's most exceptional growth companies. People define this in different ways, but for us, I think the power of a truly great business is the ones who almost reinterpret the industries they operate in. Look what Tesla's done for the automotive industry. Look what Airbnb did for the hospitality industry. Look what Netflix has done for entertainment. Those are the types of companies that we're looking for. And so from our perspective, what we think is that change drives growth. And our focus is very much on what does the world look like in 2030 and beyond. I always say to people, I think that actually having imagination is probably as important as crunching some numbers, and really kind of thinking, what if rather than what is. And this often requires comfort, being uncomfortable. So to sort of put some kind of meat on the bones of that statement, let's use transport as a good example. What might the future of transport look like? Well, for those of you that have been following the news this week, you'll see one of our holdings, Joby Aviation, has just announced a contract with Virgin, whereby if you land at Heathrow Airport, you might be able to take a flying taxi up to Manchester. So that just shows you that flying taxis, which I know when we first bought it in Scottish Mortgage in 2020, people thought we were kind of crazy. This is closer to reality than many believe. And in terms of, for us, for those that use Amazon, I think the future of logistics could be, instead of a postman delivering your Amazon box, a zipline delivery drone will drop it off at your front door. If you take something like finance, what might the future of finance look like? A very controversial idea, but we might be using cryptocurrency instead of conventional money. If you look at some luxury goods brands such as Ferrari, Gucci, they already accept Bitcoin. Could this become more mainstream? Take something like energy. What does the future of energy look like? What if you could decarbonize the chemicals industry? For example, one of the dirtiest in the world. I think it's responsible for about 30% of greenhouse gases. One of our private companies, Solugen, is attempting to do just this. They're attempting to change the way that chemicals are made using bio-based inputs instead of fossil fuels. Then take another industry like food. What does the future of food look like? So instead of, I think there was news last week, I think I saw on the BBC, that instead of getting your meat from an animal, it might be grown in a lab. Upside Foods, another one of our holdings, is at the forefront of the cultivated meat industry. So this is growing meat directly from animal cells, if you like. This is real meat without the animal, or burger without the butcher, if you want to think about it another way. So I think when you bring all this together, the key takeaway for you is that Scottish Mortgage is not investing in the status quo. We're investing in the future. We're investing in new ways of doing things. I think for many people, investing in the old ways, investing in how we do things today can feel safe and reassuring, but we think it can be anything but that. So for us, it's about really embracing that change, embracing that possibility and imagination, and embracing that progress. And I think when you look at Scottish Mortgage, what you should take away is this is a portfolio that has those next generation of winners and companies that are creating the profit pools of the future. Talking of profit pools of the future, that brings me to our private companies. As I said in the beginning, Scottish Mortgage is unique, public and private companies together in one fund. And just to recap for those that aren't too familiar, Scottish Mortgage has the ability to invest up to 30% in the trust in private companies. Today we have about 40 private companies, which equates to about 25-26% of the portfolio, with the 10 largest private companies accounting for about 2/3 of our exposure. And you can see that on the graph on your left-hand side there. You can see how that top 10 is broken down. And I think our proposition in private companies is quite straightforward. We own companies uninterrupted on that journey from private through IPO into the public markets. So shareholders can really benefit from that compounding returns over the long term. The asymmetry chart I showed you a couple of slides back, well, it has some good examples there where you've got companies like Spotify, the streaming platform, and Wise, the money transfer company, both of which we've held on that journey from private through IPO, and we still own them in public markets today. We've been investing in private companies since 2012. We've deployed just over 6 billion of shareholder capital into this asset class. But I think it's really interesting to look at what that means in practice for you. And I think this, the graph on the right-hand side of that chart is really compelling, and it really shows you the offering that we have right now, which is when you look at the top 10 most valuable unicorns. So a unicorn is a private company valued at more than $1 billion. We own more than half the world's most valuable private companies. And there's some household names in there like SpaceX, Revolut, TikTok, which is ByteDance's parent company, but also some less familiar names, the payment company Stripe and the AI software company Databricks. And again, coming back to what's our edge, what does Scottish Mortgage give you that you can't get elsewhere? Well, in private markets, your reputation really matters. This is a field which is all about access. Private companies get to choose their shareholders. You and me can't go out and buy SpaceX shares. You have to earn that right to get that seat at the table. And the fact that we have that reputation as long-term supportive shareholders gives us that seat at the table. And so being able to give our shareholders access to these companies for 35 basis points is something really that few others can match. I said at the beginning that there's a lot of noise and emphasis right now on the US. But I think it's really important just to sometimes take a step back and look at the fact that Scottish Mortgage has worldwide exposure to these structural megatrends. And this is really the benefit of being unconstrained. And so when the market has been so heavily focused on those US valuations, we've been spending our time in other parts of the globe. And a lot of our portfolio activity over the last year really reflects taking advantage of those. So Kat mentioned in her opening the digitalisation of commerce. 2 of our new holdings over the last 12 to 18 months have been Sea Limited, the e-commerce and fintech platform, I should say, in Southeast Asia. Coupang, the leading e-commerce player in South Korea. If you go over to the other side of the world in Latin America, one of our new buys last year was Nubank, which is the largest digital bank in the world outside of China. Speaking of China, another new name for us was the Chinese electric car maker BYD. They've now overtaken Tesla in the world's leading provider of electric vehicles. So I think when you pull all this together, we have a lot of exposure to trends such as AI, which are being quite US focused. But really some of the valuation anomalies that we've seen in Europe and in Asia and Latin America have caused us to really take advantage of that and adding to our positions or initiating in new positions. I mentioned BYD in the context of China, and I know China is always a topic of conversation for Scottish Mortgage shareholders, so maybe just dwelling on that for a couple of minutes. If you roll back maybe 3 years, our exposure to China was something about 20-25%. Today, that's more like 11%. And to put that into some sort of context, we are benchmark agnostic, but if you want to put it against the benchmark, that puts us at a roughly about 8% overweight position to China. And I bring that up because I thought it was quite interesting towards the end of last year. There was a well-known fund manager survey that said that being short or underweight China was the second most crowded trade globally behind the Mag 7. And you kind of ask the question, like, why does this matter? And I think it matters because it's what Scottish Mortgage is giving you, and that kind of differentiated philosophy, which is that when the rest of the world was thinking that China was uninvestable, we didn't. We tried to retain our exposure because we think it is home to some of the world's most exceptional businesses who have founders that really can scale to be some very, very large companies. And I call it the Great Disconnect because, from our perspective, China is only 3% of our index. But you look at the chart on the right, it's 20% of the world's economy. So there's a pretty staggering disconnect there. And so what we've tried to do in Scottish Mortgage is really concentrate our exposure into a small number of companies that we think offer that kind of tremendous upside if they're successful. So I said we've got about 11% of the portfolio today in China. That equates to about 9 companies, just to give you a sense. And a lot of that exposure is focused on probably 3 big ones, which is Meituan, the food delivery company, Pinduoduo, the e-commerce platform, the parent of Temu, which we may have seen here in the UK, and ByteDance, as I say, the parent company of TikTok. And all of which have very, very low valuations, but operationally are exceptionally well. So, just one slide too many there. So bringing it back to where we are today, we know it has been a little bit of a roller coaster for Scottish Mortgage shareholders over the last few years. Those highs of 2020 were followed by quite a steep drawdown. We had those triple whammy of headwinds, if you like, in 2022, where you had interest rates rising at an unprecedented rate, the growth deceleration coming out of the pandemic, and consensus really hurting or really pushing down growth stock estimates. And when you're in that environment, it was very, very hard for growth equities to really perform against those headwinds. But I think the real excitement for us has sort of come in sort of late 2023, early 24, when I say we saw those headwinds turn to tailwinds, if you like. And there's 3 layers of tailwinds you can think about in the Scottish Mortgage portfolio. The first is the revenue growth that's embedded within our holdings. Just to give you a sense, the average revenue growth of our public companies is nearly 3 times the index. So our top 10 public companies are growing their revenues on average 40%. Our private companies is more like 80%. So when I'm talking about exceptional growth, this isn't GDP plus growth or average growth or GARP type growth. This is really that top decile growth that we're looking for. The second layer relates to how adaptable I think our companies have been during the last couple of years. Our founders and management teams have really done a very good job of pivoting their businesses to the new capital environment that we find ourselves in. And what I really mean by that is that the last decade was probably characterized as an era of capital abundance, if you like. Cheap and easy capital was there. But 2023, you saw that backdrop change to one of capital scarcity. And our companies realized that this sort of growth at all costs model would no longer be rewarded, that now you had to have growth with some cost control in there. This was a more favored approach. Companies wanted to be in control of their own destiny, not being reliant on external financing. And what you've seen is the proof come through in the numbers. So the average profitability and cash generation of our portfolio is up over 100% year on year. So if you think about it, you've got very, very strong revenue growth plus improving profitability and cash flow. But then the cherry on the cake, if you like, which almost supercharges the other two, is that these companies are all underpinned by these strong structural drivers. We've long said that what matters for companies is not interest rates or not inflation or what GDP figures are, it's those deep underlying structural changes in the world. And so I think when you pull all that together, we really see the portfolio being in very, very good shape. And I thought it was just an interesting slide to finish on, which is the very, very long-term performance of Scottish Mortgage. Scottish Mortgage is nearly 100 years old. During that time, we've needed to have endurance, we've needed to be resilient. We've kind of soared upwards, we've seen some crashes, we've adapted, and we've gone again. And I think it's interesting that the vast majority of the market probably don't look for longevity, they're looking for that instant gratification. But you come back to first principles. What is the purpose of Scottish Mortgage? It's to own the world's most exceptional growth companies, to be open to change, to back those founders, and to invest in them over the long term. So with that, I think I've spoken for just over 20 minutes, so I will stop talking there and make sure I can address any questions that have been coming in. Thank you, Kat.
Hi, thanks very much for that, Claire, and lots to discuss. Thanks for taking us through some of your recent thinking there. Just a reminder, you can ask some questions for Claire if you just put that in the question chat function at the bottom of the screen, and we'll try and ask her those. Yes, so Claire, let's follow up on some of the things you've been talking about and go into a bit more detail, especially about what's happening at the moment. Now, I know we talked before this, we were talking about Tesla, as you discussed, but also I think the big question you've been getting a lot the last few months is about Elon Musk. Obviously, making a huge amount of headlines and over the last few months, his proximity to Trump and what he's been involved with, which has impacted some of his companies as well. Maybe you can just share your latest thinking on that. I know you've always said in the past that factoring in the Elon factor as being part of your investment there, but how is this kind of shifting a little bit?
So just to recap what I said during the presentation, we have taken quite a lot of profits out of Tesla this year, and I say that was very heavily weighted towards the last quarter of 2024, where you saw something like $500 billion of market cap added to Tesla just after the election on the basis of that kind of Musk-Trump connection. But from our perspective, what we're really looking at is the operational progress of the business. And Tesla's at quite an interesting juncture. I would almost characterize it's between two growth waves, if you want to call it that. So Tesla 1.0 was all about automotive. You've a company gone from nothing to, a year or so ago having the Model Y being the best-selling car globally. I mean, that's a staggering achievement, in itself. But on the automotive side, there's been a little bit of, stagnation around the pipeline, the product pipeline, where we're going from here. So we're kind of in this period where we're waiting for what does Tesla 2.0 look like? And for us, Tesla 2.0 is probably less about the automotive part of the business and all about the robotics and the autonomy part of the business, which I think if you've listened to Musk recently, he wants Tesla to be an AI company. Yeah. And really the reason for selling down as much as we have is that while we're very excited about the potential for autonomy and robotics, they're still quite nascent opportunities. They're still not contributing much in terms of revenue. So the reduced position really reflects where we see Tesla as a business between those two growth waves has really been the major reason for that reduction cap.
Yeah. But what about the Elon factor? Because maybe perceptions have changed. And he's obviously his influence has changed over the last few months. And you've got SpaceX there as well. As your view is starting to change about him as the founder there?
Yeah, I mean, I'll use maybe a quote from the chairwoman of Tesla, who had a very, very good way of thinking about the Musk factor. And she said that, she might wake up in the morning and see a tweet from Elon, about, something and commenting on the political landscape of whether the US or the UK or Germany, and be surprised what he says. She said, I'm never going to wake up in the morning and see a tweet from Elon on the strategic direction of Tesla changing. And I thought that was a very, very good lens, a very kind of objective lens in which to look at the situation. We're investing in the business. We're investing in Tesla as a company. This is a business with strength and depth, beyond Elon. Elon is a visionary, as we know, but you can see, over our time of holding the stock, just how many people there are around him. And I would echo the same at SpaceX as well. A name that may not be familiar to many, but is probably one of the most influential and phenomenal people, I would say, in the world right now is Gwynne Shotwell, who is the president of SpaceX. She's been there for 20 years. She's an engineer by background. She is very, very much a driving force of SpaceX. So I think it's sometimes just there's a lot of noise around Musk. But from our perspective, we're looking at the businesses, we're looking at the operational progress that we're making. SpaceX continues to go from strength to strength. If you look at the last month of 2024, you'll maybe have seen in Scottish Mortgage communications that the SpaceX valuation increased to 350 billion, which makes it the largest private company in the world. And again, we've made very good returns for our shareholders there. This is a company, I think, that has two monopolies. You've got a monopoly on launch, and you've got a monopoly on that kind of satellite internet, if you like. So SpaceX goes from strength to strength, but this is a business more than just Musk. There is a lot of people there behind the scenes driving this forward.
So you hope that'll be reflected for Tesla, the short-term noise around Elon and the impact on the share prices. You sense that's maybe just short-term around at the moment?
Yeah, as I say, we've held this since 2013, and it's been one of the most volatile rides, I think, from our perspective. And I guess you just see that continuing. It's one of those stocks that I think is always going to have those volatile characteristics. But for us, what we're looking on is the revenues, the earnings, the cash flows, and the valuation. That's what we're focused on as investors.
Yeah. I wanted to ask you about the wider AI theme. You mentioned NVIDIA there, and your changes to the position there. I think the big story for this year was around sort of DeepSeek coming in, and that and people then starting to think around how AI was developing. And I think it created that discussion, didn't it, around the infrastructure of AI, what's actually needed. How did that change your thinking? You're obviously know about some of these new players coming through, but have things changed in terms of how you see this sector developing?
Yeah, I'm just going to put a slide. I don't know if it's possible. I'm just going to put a slide back on screen there. I've got an AI slide. I don't know if the viewers can see this, but if I can sort of articulate how Scottish Mortgage sees artificial intelligence, I think there's three buckets, if you want to call it that. There's the picks and shovels, the kind of hardware and chips is the kind of first part of the value chain. You've then got the kind of infrastructure, and then you've got the kind of the applications. And so from our perspective, a lot of our trading has been in that first bit in the hardware. So what we've done really is take a lot of that profit out of NVIDIA. As I said earlier, we've gone from it being our largest holding to about a 2% position. And as I say, NVIDIA has been in a phenomenally, unique position, shall we say. It's been at the absolute forefront of AI. It's been the AI trade. It's been the way to play this. But there have been some short-term challenges from our perspective around maybe customer concentration risk amongst the hyperscalers and some supply chain constraints. Get my words out there. If you put this in the context of what I said about sort of seeking outliers and that return that we're looking for, and that desire for asymmetric returns, at 3.5 trillion of market cap, we're kind of challenging ourselves in the ability for that upside from here. Can we see it making that kind of 5x return from here? And so I think the kind of range of outcomes for NVIDIA is more symmetric than asymmetric, if that makes sense. So that's really been a lot of our rationale for taking some money out of NVIDIA. In that first part of the AI value chain, we've also taken money out of our ASML holding. So just to recap, ASML is the Dutch leading maker of lithography machines. They make the machines that make the chips in a very simplistic way of talking about it. And again, there's some headwinds facing ASML, kind of on China, the restrictions on exports to China being one. The company's undergoing quite a significant management transition. There's also some worries about the continuation of Moore's Law. So I think when we've combined all of that, we have taken quite a lot out of our ASML position as well. That's roughly halved over the last 12 months. But what we've done with that is we've put it into TSMC. So on that kind of picks and shovels part of the value chain, a lot of those profits have gone into TSMC. And TSMC is the manufacturer of AI chips. And essentially we see this as, I guess, a royalty on kind of AI and compute. TSMC is going to benefit no matter who wins. They're everyone's foundry, if you like. So I think that we just see TSMC as probably one of the best ways to play AI, over the next 5 years. And again, coming back to what I said earlier, that kind of valuation anomaly, the fact that it's, an Asian stock was a really compelling valuation when we bought in. But coming into the kind of infrastructure part of it, we have companies like Snowflake and Databricks, who are really kind of using AI to help enterprises structure their data and help, drive some insights, applying these large language models to it. And then you're coming down to the application layer, we have many examples throughout the portfolio where you're seeing AI being used and monetized, which is really one of the key things. So companies like Meta right now is probably one of the most obvious ways to monetize AI. We've got companies in healthcare who are using AI to help with drug discovery. So I think when you pull all that together, we have a lot of exposure peppered throughout the portfolio, but the majority of our portfolio trading has been in that picks and shovels part, in that first part of the value chain. Is from a Scottish mortgage perspective, where we've
And how are you researching? Obviously, you're speaking to all these big AI players, and you're reading. There's so much information there around how this is developing. What have you found useful in trying to keep on top of this sector?
So I think we're very fortunate that we have very good access to founders, and I think that what has helped shape our thinking is having companies who have what I'd call technical founders that really understand this technology. And I think that that's an advantage, because when you have something like a new technology, the ability to deploy that effectively or to pivot your business because you understand the trajectory, is incredibly important. So, I would put people like Mark Zuckerberg in that category. People like Daniel Ek. I think just after ChatGPT came out, he was one of the first people to say AI is going to change our entire business. I think he was the first to license an AI DJ. Shopify founder Toby Lutka, again, pivoted the business quite materially, shifting it from logistics to AI. People like Dr. Kai Yu of Horizon Robotics has been researching AI for 30 years. So having access to these founders who really understand this has really helped shape our thinking.
I want to just talk a little bit about, as you mentioned, obviously, the sort of market environment at the moment. And I wanted to ask you about the impact of tariffs, not on a sort of global basis. I know you don't want to talk, you don't want to sort of focus on the macro discussions there, but especially about, the impact on the companies in the portfolio. I mean, obviously the tariff policy seems to be changing quite a lot at the moment, but how has that impacted your thinking? You've got companies obviously with global reach, global supply chains. What are kind of key things you're looking at from a company perspective on what the impact could be here?
I think honestly it's too early to say or to draw any strong conclusions. I would maybe answer this question with what I kind of ended my comments on, which was just about the adaptability of our businesses. I think that's really what we focused on more and more, is just how adaptable our companies have been to changing landscapes. And I think the fact that you've now got our businesses in a much healthier profitability and cash flow profile gives them more ability to deal with these changes. As I say, we don't know what's going to happen with tariffs. I don't think anyone can predict, and we're certainly not going to make big moves in the portfolio, on speculation. We are focusing on those sort of longer term structural trends that I talked about. But I would say over the course of the last kind of few years, I think you've really shown just how beneficial it is having that adaptability, but also having founders there who have the courage and bravery to take difficult decisions and to pivot the business, in response to what they're seeing around them. So I think by having, we've got something like 85-90% of our companies are founder owned.
Yeah.
And I think that's a really, really distinguishing factor. And having, as I say, having that ability to steer the business in the right possible way, and dealing with whatever sort of headwinds, I guess, are in front of them. But
Yeah.
yeah, not a very good answer, but I don't think
Yeah.
we don't have any, we're not making any predictions or factoring it into our analysis at this moment in time,
Yeah.
because as I say, it's changing on a almost weekly basis at the moment.
Yeah, and we know some of the fund managers that we've been speaking to recently. I mean, obviously they're talking about how people have been preparing for this, particularly some Chinese companies thinking around this for a few years now, how they might adapt. But yes, you say it's sort of trying to look ahead too far with this is difficult at the moment. I wanted to talk to you about, you mentioned obviously about the volatility of some of these, companies that you're invested in, and it's something that you might have to be prepared for if you're invested in this type of strategy. But I was just wondering how you can help sort of manage this, and any lessons from 2022 in particular. I know when we've had other managers on from Baillie Gifford, they've been talking a little bit about the process since then and how it made them think about the portfolio and the resilience in different times of market conditions. So I was just wondering, in terms of Scottish Mortgage, that sort of impact there, and especially around, because this is what's obviously the big issue going to be for clients, is looking at that volatility. It's very hard. We've got times like the moment when there is that volatility has been heightened.
And I think it's important to say that volatility is not always a bad thing, right? You can
Yeah,
obviously take advantage during
yeah,
bouts of volatility. It's not always has to be a negative. But as I said earlier, we're very comfortable with volatility. We know that's part and part of our process. But to answer your question, I guess, on the kind of the lessons learned point of view, you know, there's a couple of things I would say. I think that the resiliency of our companies, that cash flow profile, when you go back, if I go back to 2020, that kind of cheap and easy capital, low interest rate
yeah,
environment, it didn't really matter if you were like burning through cash, because you could just raise more. We're in a very, very different environment now. So I
yeah,
think when I look at actually what we spend probably more time versus back then looking at is the cash flow profile, particularly in the privates. What's the cash runway? So looking at how much cash they're spending per year on what their cash on hand is, making sure they've got ample years runway ahead of them. Also in our public companies, there's a very small percentage of our companies that are negative earnings or negative cash flow actually now. And again, coming back to that points I was saying earlier, it's because you've seen the cash flow and the earnings profile improve quite markedly as companies have taken those steps to
yeah,
rationalize their cost base, focus on efficiency. So you've really seen that come through in the numbers. So it makes us quite comfortable from the portfolio perspective. The majority of our companies are net cash. They've got strong balance sheets. They've got improving cash flows to be able to redeploy that back into the business. And that's the other thing I should say as well, is that with a lot of our companies, it's not just that they are becoming more profitable and they're saving and they're hoarding cash or they're giving it back in dividends. If you actually look, I think the last numbers I looked at was our average research and development as a percentage of sales was roughly 4 times the index. So our companies are still spending money on innovation and growth, which is what we want them to see. But they're only able to do that because they have that cash on hand. So
yeah.
I think the lessons learned is just really looking at that kind of resiliency point, the cash flow profiles, because we are in a different era now, as I say.
Yeah. And I wanted to ask you as well about the private company exposure there. And there's obviously been a lot of focus on private markets, including from the regulators who are honing in on certain areas, but particularly valuations. And I know you have a strong process in place there, but maybe you can just share a little bit about valuations there and your process around that.
Yeah, sure. So I think actually one of the big differentiating points of Scottish Mortgage is our valuations process. And I mean that in a relative context. So if you look at other trusts or other funds that own private companies, private equity trusts or VC funds, they will typically only revalue these assets on a 6 monthly or quarterly basis at best. Which what that means in practice is you've got some stale prices within those companies. What we are trying to do at Scottish Mortgage is hold our private companies as close to fair value as possible. So what that means in practice is, what they would change hands for, between me and you tomorrow, should we need to. And the result of that is we are revaluing these companies constantly. And so to give you some numbers on that, out of the kind of 40 companies that I mentioned at the beginning that we had, there was something like 420 revaluations in the last 12 months. Just to give you a sense, that means on average, these companies were revalued 5-6 times during the year. The big difference is if we are making a change to one of our valuations, they are reflected in the NAV the very next day. And so why that's important is that we will take into account, what's happening in public markets, what's happening in the peer group, so that's reflected in these companies. So like you've seen in the last couple of weeks, obviously there's been a lot more volatility in markets. We're looking at our private companies, making sure that kind of sentiment is reflected in those valuations as well. And as I say, they are reflected in the NAV, the very next day. And so what hopefully we give shareholders comfort on is that there is no stale prices, in our portfolio. We are holding them as close to fair value, as we think. And I think that's the big differentiating point with our process. And then maybe just one other thing on the valuations process is that the investment team, people that work on Scottish Mortgage aren't actually involved in that valuation process. It's done by a completely independent third party within Baillie Gifford, but that's also verified and checked by an external third party, S&P Global, go through all of our valuations. And then there's another layer of checks, which is our auditors. So the auditors of Scottish Mortgage will look at those valuations. And then if you think about it kind of more holistically, we've got the auditors of the other Baillie Gifford trusts who own similar companies. So if you take something like SpaceX, we own it here, the US Growth Trust own it, EWIT have it. So you've got the auditors of those trusts looking at the valuations. So I guess that's a very long way of saying there's lots of eyes, layers of different eyes looking at these valuations, and that checks and balances are in place. So that's kind of why I say there's a very, very robust process around our valuations.
Yeah. I have actually got a question here about the Baillie Gifford sort of range. So the question is, to what extent does your research overlap with other Baillie Gifford funds, BG American, BG Global Discovery, and are holdings replicated across these and other BG funds?
Yeah, I mean, there is definitely overlap between Scottish Mortgage and the American fund. So because we have some of our portfolio managers, or like Tom Slater, for example, he sits on Scottish Mortgage, but he's also head of our North American desk. So there is overlap on holdings there. But the key thing to mention is that the decision makers are completely independent within Baillie Gifford. There's no overarching chief investment officer dictating what companies should be in each portfolio. Each team, whether it's the Global Discovery, whether it's American, whether it's us, or whatever strategy, positive change it is, they all have independent decision makers, and there's no kind of overarching house view, if you like. So we can quite often take different positions in the same stock within the firm, and that's not that uncommon.
Maybe you could just say something briefly about managing the discount on Scottish Mortgage. Been doing share buyback programs. What's been happening there?
Yeah, sure. So just about a year ago, actually, nearly bang on a year ago, the board of Scottish Mortgage announced a commitment to buy back at least £1 billion worth of shares. I say that was in March of last year. To date, I think we've bought back about 1.6 billion of shares. And the rationale here is that, we really want the share price and the NAV to be trading as close to each other as possible, and really just sort of to help facilitate that, was the logic behind the buyback. So we continue to be active in the market today, the same way that we issue when we're at a premium. We think it's the right thing to do to be buying back, when we're on a discount. So right now we're on about an 8-9% discount, roughly in line with the global investment trust sector.
Yeah.
Obviously, by having private companies in there, there's additional weight given to what the private company investment trusts are on. But from our perspective, it's the desire to try and get that share price and NAV as close to as close to each other as possible. So yes, we remain committed to the buyback is the main message.
I know we've got sort of a few minutes left, so let's just, I know you talked about it in the presentation as well, but, big discussions at the start of this year around concentration risk, concerns about, you mentioned valuations in the US, obviously seen a correction in the US markets, and it's been a difficult few weeks for investors. What have you been doing over the last sort of couple of months in particular, and how are you sort of viewing that? Obviously, as you said, you're a global trust with global reach. But it's obviously going to be a big question you must be getting from clients around that US sort of weighting there and how you're viewing that.
Yeah, I think the concentration one's interesting because I think that when you just had so much column inches and time dedicated to Mag 7 concentration last year, I was sort of saying that we are very concentrated in Scottish Mortgage, in terms of where our top 10 and top 30 positions are. The top 10 is what, about 30-40%. The top 30 is about 70-80% of the portfolio, just give or take over the year. But our top 10 looks very different to what everyone else was talking about concentration. So our top 10 includes SpaceX. It includes the Latin American giant Mercado Libre, which is the e-commerce platform. It has companies such as Ferrari in there, European giants. It has Meituan and Pinduoduo in China. So we are concentrated, but in a very, very different way. Yeah. And I think that's really important in a world of, when you're wanting your active manager to actually be active and be different. Yeah. You've got, by having a very different concentration, that kind of offers differentiated returns. And I think that actually, when I look over the year last year, a lot of our biggest winners came from those names. Yes, NVIDIA was very strong for us, but Meituan was also a big winner. SpaceX was a big winner. Mercado Libre did very well. So I think it's really important just to highlight the fact that, we have been doing quite a lot, ex Mag 7, if you want to call it that,
yeah,
and taking advantage of the exciting opportunities we see elsewhere.
Yeah, and you mentioned those valuation concerns about the US, and but I presume you're looking more globally for those opportunities, and it's to thinking about what's the best growth opportunities rather than thinking geographically in that sense.
Absolutely. I mean, we remain bottom-up stock pickers, and what you see in the portfolio is the output of where we see the best opportunities globally. And it just happens that in the last sort of 12 to 18 months, the majority of our new buys and our additions have been, as I say, more focused on Asia or in Latin America or in Europe, just because of that kind of risk reward and that asymmetric return profile, what we're looking for.
Yeah, and just in terms of the last few weeks, we've obviously seen that correction there, and you mentioned those sort of opportunities opening up with that volatility. Yeah. Maybe you could just highlight a little bit about what you've been doing on the portfolio in the last sort of few weeks, taking advantage of those.
I'm not sure I can reveal the last couple of weeks. I don't think that's publicly disclosed yet. But I think it's probably just a continuation of what I've sort of touched on in terms of where we've been taking some money out of and where we've been putting some money into. It's probably more a continuation of that, I would say.
Okay. Yeah, and just finally, I just wanted to just touch back on private markets again, because I think it was interesting what you were saying. And imagine in Scottish Mortgage's history, the way that private markets have been viewed has changed a lot, and particularly what you were saying about companies being private for longer. I was interested to hear, so what the opportunities that that's presenting to you from you in that part of the portfolio, because it's a really interesting time, isn't it? You've got SpaceX, as you said, but it's a definitely different dynamic than when it was a few years ago.
100%. I mean, I think that for me, private companies are that kind of lens into the future, right? They're where you find the emerging technologies that aren't very well known yet, that you can't really invest in public markets. So, take something like quantum computing. We're hearing quite a lot about quantum computing in the first couple of months of the year. One of the companies that we have in our private book is PsiQuantum, who are one of the leaders in this field. They've signed big contracts with the Australian and US government to develop, probably one of the world's most powerful super quantum computing. Sorry, I mentioned in my comments about technology such as cultivated meat, synthetic biology. All these fields, if you like, are still quite kind of. They're really not too familiar in most people's perception, but as I say, I think these are where you could find some massive industries in the future. So our private markets give us that lens, if you like, into the future. And that also helps us think about our public holdings as well, where we're seeing disruption coming. And we're able to identify that disruption probably a lot sooner because we have access to the kind of emerging technologies that are coming through. So from our side, I think that the private companies is such a differentiating point for Scottish Mortgage. And as I say, it is the best and biggest private companies in the world that we have the privilege of having access to. But as I say, we want to be able to make sure that our shareholders can benefit from that, and by offering it at a very low cost. When, if you try to get that access in a private equity trust, you're probably going to be charged a 2% management fee and a 20% performance fee. We have 0.35% management fee and no performance fee by comparison. So that means that more of that return goes to shareholders direct rather than us, which I think is really important. So we continue to really be excited by the private companies, and we think it really remains quite a differentiated proposition that you can get liquid and low cost access to this asset class via the trust.
Okay, well, thank you so much for taking those questions there. Thank you for updating us on what's happening and your views on the trust and the market at the moment. Just before we wrap up, let's take a look at those learning objectives again. Should be coming up on the screen for you. So by the end of the session, you should be able to understand the unique philosophy that sits at the heart of Scottish Mortgage, understand why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it's rational to seek out the exceptional companies driving this change to maximise your chances for growth over decades, and understand why the current environment leaves room for optimism for investors willing to take a long-term patient view. If you do have any other questions, I'm sure Claire and Baillie Gifford will do their best to answer these after the event. And just to remind you that CPD should be delivered tomorrow. Just before we close, I'm a bit of a teaser of what's to come from professional advisor events over the coming months. Our next online working lunch will be on the 23rd of April. We'll be speaking to Baillie Gifford's Tom Patchett about Japanese equities in a session called Beyond the Cherry Blossoms, a fresh perspective on Japan's growth potential. Then on the 1st of May, we'll be hosting the annual PA360 conference in the city. This year's conference will have a collection of over 40 speakers. We're covering all the big areas of interest to you: investment, technology, protection platforms, retirement planning, M&A, and of course AI. And we'll be joined by our keynote speaker, Alistair Campbell. It should be a great day, so we hope to see you there. Then on the 14th and 15th of May, we'll be running the 3rd edition of our successful Professional Advisor Management Retreat at Wootton House near Dorking in Surrey. This is a 2-day conference aimed at those who own or are senior directors of advisor firms. And again, over the 2 days, you'll have the opportunity to attend sessions from our 6 sponsors and listen to some fascinating keynote presentations from a variety of outside speakers. So places are strictly limited, so please register now to avoid disappointment. And then on the 18th and 19th of June, we'll be up in the north, our new Northern Retreat at Carden Park near Chester. And again, keep an eye out for that and register your place ASAP. So in total, that's 24 hours CPD, 25 hours CPD over the coming months. And if you do want to find out more information or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. Tonight, we have the big Professional Advisor Awards, which are now the biggest awards event for advisors in the business. So we hope to see some of you there as well. But that's it from today's session. Thank you very much again, Claire, for your presentation and taking our questions. I hope you found the session helpful, and we hope to see you at another Professional Advisor event very soon. Thank you.